Hi and welcome back to Ask Becky Anything. This is where you can send your questions in to me on my WhatsApp and I will play them on the show and give you the answers. Hi and welcome to Accelerating Your Wealth with your host, myself, Rebecca Robertson. I'm an independent financial advisor and wealth coach. I'm the director of Evolution Financial Planning, who is also our sponsor for today's show. Don't forget to like, subscribe, share and review this episode. With your help, we'll reach more people who can benefit from the show. If you're somebody that is not sure what to do with their finances, maybe you're working and you're not sure what to do with the bonuses you've got at work, or maybe you started a business and you've got profits and you're not sure what you should be doing to enable you to A, pay yourself more, or B, potentially retire earlier. Maybe you're somebody that's thinking about, do I overpay on the mortgage? You've received some inheritance. You've got lots of questions around your finances on what to do next. Then check out Evolution Financial Planning, who are regulated independent financial advisors and financial planners that can help you make some of those big decisions in life. I found it really interesting actually. I find myself repeating myself, but if it means it gives an answer and delivers it in a way, A, because the question's been asked a certain way, or B, I've answered it in a different kind of context, then that's fantastic. So let's see what we've got next.
Hi Rebecca, my name is Sherry Bevan, and I work as a team culture consultant. I help organisations get new teams off to a brilliant start so that they start to deliver results from day one. I've been running my business for 14 years and coming up to the time where both I and my husband are thinking about retirement in the next 4 to 5 years. We have always saved and put aside money into our pension pots, and we've got a good amount of money in there. Someone suggested to me recently that it would be a good idea to do a drawdown now into an ISA. I just wondered if you think this is something worth considering, what the pros and cons are, the benefits and any disadvantages of doing that for us. We think we will probably want to retire in about 4 or 5 years' time, if that helps answer the question more effectively. Thank you so much.
Great question. So this is the typical, somebody said I should do that kind of scenario. And just because someone else did that doesn't mean that it's right for the other person. I did a show recently which was explaining the difference between advice and guidance. So me giving this information to you now is guidance. It's purely information. I don't know personal circumstances as to whether that should be the best advice to you. Now, when it comes to ISAs, the ISA allowance per year is $20,000 per person. So if you're taking a tax-free lump sum of 25% and you're taking it all out of that investment pot, the growth of that investment pot within a pension is not taxed. So whilst it's growing, it's not taxed. It's only while you take it out, the remaining 75% is taxed, depending on what rate, like how quickly you take it out will depend on your income tax ratio, the rate of tax. But you can still take out 25%, obviously, without any tax. So if you're moving it out of this growth environment and you're putting it into an ISA is capital gains tax, income tax free. So you'd think it's like for like, but it's not, because you can only do £20,000 each. So therefore, if you're taking out 100,000, it's going to take quite a few years before actually all of that money can be invested. So in the meantime, if you invest it, then yes, you can have it invested the same way. The ISA and the pension can be invested the same way. This investment pot, or general investment pot, can be invested in the same way, same risk ratios, same diversity, etc. But it's not tax-free. There's no tax benefits to that kind of wrapper. So therefore, the growth, you will be paying income tax or capital gains tax, depending on how it earns interest or income. So I don't really, if I'm honest, get the reason why you would do it in that nature. You could take some out for a certain purpose. You could reinvest the money, of course, but I would only normally do that in certain circumstances. The big rule that's coming into play next year, which is 2027, April 2027, depending on when you're listening to this, means that pensions as of now in 2026, if you was to pass away before the age, at any point actually, I'll start there, at any point, then your pensions are not liable for inheritance tax. After next year, they are. Now, the rule right now on both instances is that after the age of 75, if you pass away, your pension is inherited. As of next year, you're paying inheritance tax. But also, you're now or next year, the person that inherits will pay their marginal rate of tax when receiving that pension. So what that means is that you really want to spend that tax-free allowance before you get to 75, essentially. And I'd say that's really the main message. It's not about cashing it in, de-investing it, putting it in the bank, because actually all the time it's in a better tax-free wrapper growing. That's more important. You can draw drips and drabs, if you want to, of tax-free income at different points. So specifically moving it into ISAs, it'd actually be very limiting. You'd have to do that each year, every year, as a transactional base, topping up your ISA each year. Which if you have other money, you might want to use other money to do that. But I wouldn't necessarily look, there's certain circumstances that I would only personally look at taking a 25% and then leaving it sitting in a bank account to then put back into an ISA. If it goes into a cash ISA, then interest rates are lower, so it won't possibly have the same level of returns as the potential it could be invested in a pension, depending on what risk you're taking. And if it's then going to go and sit in cash, and it's not getting a high interest rate, not only will you then have obviously income tax or capital gain tax to pay on the returns, but those returns actually be quite small and it possibly won't keep up with inflation. So there's a number of issues that I've got with that. My mate said do this kind of setup, which is why it's very important to actually get personal, bespoke financial advice to your personal circumstances. So no advice is given in my statements I've just given. This is just purely factual information to give guidance and point people in the right direction. By speaking to myself personally or a financial advisor personally one-on-one, we should gather and understand your personal circumstances, and then you're paying for that bespoke independent advice. But thanks for the question. It's a really good one. Did you know I wrote a book? It's called Accelerating Your Wealth. Funny enough, the same as the show, Accelerating Your Wealth podcast show. But this is 10 ways to accelerate your wealth. It was designed to really help people with their finances in a simple way. So we focus on some key sections around your money mindset, some practical things that can be done with your finances and allowing you to maximize your money and your future. So if you're thinking, hey, this stuff is interesting, then the best next step for you is to check out the book. It's an Amazon 5-star bestseller. Yeah, I know, it's great, right? Go and check it out. You can buy it on Amazon and have it with you tomorrow for a nice cup of tea.
Hi, Rebecca. So I have a question around divorce and when's the good time, best time to seek the advice of a financial advisor when you're going through divorce, because it's an overwhelming process that can take weeks and months and years. And at the start of the journey, maybe it's too soon. And then by the end of the journey, you're so exhausted, you've probably made some poor decisions and feel that it's all too late. So I'm just wondering what's the best way to bring the financial awareness into a divorce process and make sure you're making the best choices as you go along, and how a financial advisor can help and support that process. I hope that's a coherent question. Look forward to seeing the answer. Thanks. Bye.
Great question. And I say that with everyone. Everyone's a great question. Okay, so this is a bit of a chicken and egg sort of kind of issue, because a financial advisor can't give you legal advice, and the legal advisors will only give you so much guidance when it comes to the financials, added to the fact that if you're not so far along the process, you won't actually understand what all the figures are to be able to make some decisions because you haven't had full financial disclosure. So it can be tricky where you're sort of having to juggle things at different stages. It's not a linear process and everyone's is a little bit different. So it's actually quite a hard question to answer. Once you've got that financial disclosure and you understand what your potential options are, then at least then you can do some scenario planning. Whereas before that, and you don't understand what your partner has got, or even what you've got or what you're going to be doing next, it's very difficult to start putting some planning in place. Once you've got some of the basic questions, like I said, like the basic facts, like you know how much they earn, you know that maybe if you will get a mortgage or you won't get a mortgage, we can start looking at scenario planning around that. And we can start to build in some factors. So a couple of clients, we've had to sort of play around with some scenarios and some numbers, and then they've taken that back to their lawyer. Months have gone past, we've not heard anything. Then they come back, we adjust it, they're about to go to court. We've got some more facts and figures, some different scenarios. Maybe we've done a mortgage capacity agreement so we can work out if they can or can't get a mortgage. We've possibly looked at if they were to sell the property family home, if there was to be bought out of the family home, or if they was to remain in the property, possibly receive maintenance or child maintenance. Maintenance is difficult unless you're that much older and you've had a long time out career-wise. Younger women, who mainly I'm speaking to, they're often in work actually now these days, and so therefore the courts view it's more around not a it's more of not spousal maintenance, it's more of a child maintenance issue, and around who's going to have access to the child and when they're going to have access to the child. And then that comes down to a lot of parents then saying, well, we'll have 50-50 and then I haven't got to give her or him any money because we're splitting it between us. So that's when it starts to really get a bit tricky, because money then starts to navigate into basically relationships with children. For some women, they can't afford to go back to work, or they can't afford to extend their hours because they're having to navigate around the children. And some men are not able to work flexibly as well as they'd like to maybe do school runs. So that then starts to limit, and that then affects how the financial setup is in terms of them taking time off work or taking time to pick the children up from school and care for them for certain days. So having children and divorce is quite a thing to navigate. If you haven't got children in the equation, then and you're potentially slightly older, then a lot of women, either way, they want that clean break. So again, if you don't have the financial figures or the scenarios, it's hard to understand. And so it's quite intimidating for a lot of people anyway, because like the lady mentioned, Sarah, in the voice clip, it's really unknown as to what you're actually going to be getting yourself into. And I notice a lot of women actually stay in relationships because they're not able to navigate this. And it's one of the main reasons I really am a real advocate for being financially independent and having open conversations about finances so you understand where you are and where the family's finances are. Because at the end, you could be arguing over the most silliest thing, but also equally, it might be that, you know, people are having to not just move house, but move out of area, move away from their friends, from away from their family, because they can't afford to live in that area anymore, which I see quite a lot for London families particularly. So unfortunately, there's not like a straight answer to this question, because it really does depend on how prepared you are with the financial element to run through those scenarios to give some real meat on the bones that allows that peace of mind. And that can take a little bit of time, depending on how open both parties are when it comes to disclosing their financial circumstances. So I hope that helps. Thanks very much. So thank you for your questions from Ask Becky Anything. I'll be back again with another show and segment. Do send us your questions in. We'd love to hear from you. Take care. Thank you for joining us today at Accelerating Your Wealth with your host, myself, Rebecca Robertson. I hope you enjoyed the show. Do subscribe and let us know in the comments any of your thoughts.